Good morning, ladies and gentlemen. Well, I've been saying that we are transitioning into a highly technical market with lower volatility, therefore not to expect larger moves. And that is precisely what we have got. Equities are bid together with bonds. As long as bonds don't make big moves, equities are not going to feel pressure. As volatility comes down, so people cover bad short positions in equities. And that is basically what's happened all week. And I think that that's going to continue happening. There's going to be technical reactions, of course, but the risk profile of the market is one of risk on, with the risk dial in mildly positive territory around the 45 area. So there is nothing really to write home about, and I don't want to waste your time this week. I want to go very quickly through the state of the market and do some maths together with you and show you what the market is expecting for FOMC. And therefore what you can expect over the course of next week, in which we have both the Fed and the ECB, but at the end of which, at a guess, gun to head, things are not going to be very, very different from what we saw this week. So let's do a quick run through of the yield curve and the individual tenures in the US. This is the 1 year. I just want you to see how we basically haven't moved a tick since the beginning of November. So the market is absolutely stuck dead, whether we take the 3-month, which has gone up to meet the expectations of a 25 basis point cut, or we take the 1 year. We are steady. We are waiting for the next direction from the Fed. What is moving is the rest of the curve, but it's moving very, very little. Highly technical market. You're looking to make 4 or 5 ticks and get the hell out of there. Is the 2-year going to move all that much? Well, I'm going to give you my thoughts on what if I were the chairman of the Fed, what I would do and what I would say. Now, all these ideas that somehow he is going to be very hawkish, to me, are ridiculous. Because if he wanted to be really hawkish, he would move by 50 basis points. But we all know that he's going to move by 25 basis points. The Fed hates to surprise the market. They've telegraphed, every speaker has said, 25 and then possibly another 25 and then a pause. So they are not going to surprise the market. They're not going to do anything but what is expected. And therefore, even if he talks hawkish, what's that going to achieve? Actions speak far louder than words. He might say, I don't like the fact that the market is easing conditions. Okay, you don't like it. So what? That might give us, another 5, 6, 10, 15 basis points to the upside for a few days. But then the market is going to retrace them, because it's going to say, well, you're data dependent, and therefore you will do what the data says. Why be into NFP at ridiculous levels like 455, and then the NFP comes out and is as expected? I don't think that is really what they are after. That they want to maintain current conditions for a long period, a sustained period of time. And if that's what they want to do, they want to see the market meandering around these levels without really making a huge amount of outright movement close to close. If we look at the fives, basically we are at the same level that we were at the beginning of December. We've just gone up and down and up and down, and that's what I think is going to continue here until we get a set of data that says, no, they either have to hike a lot more, i.e. inflation is sticky, and we all know which part of inflation needs to be sticky for that to happen, or we get a substantially lower inflation number than the one they are projecting. Don't forget, we're not comparing the inflation numbers to what the market thinks the inflation number should be, but what the Fed's target for that month for inflation is. So if inflation starts going down faster than the Fed projected it would, why would they be bearish? Why would the Fed want to cause rates to go higher? To me, that makes no sense. At the moment, we are going down faster than the Fed projected, or as fast as the Fed projected. So why would they be unhappy with that? To me, that makes no sense. To me, that says two things. They should be happy. They should do 25. They should say that they will do another 25, but that they are data dependent. I just don't see any reason why they should say, oh my God, I am so bearish. You guys are completely mispriced. It doesn't make any sense to me. It might happen, but it just does not make much sense to me. What will happen if the Fed says now, oh dear God, we are very mispriced, which they're not going to? Well, it's the short end that's going to react the most, with actually the long end not reacting very much at all, is my idea. If we look at the 30s, they are the ones that are moving the least. And certainly if we look at the yield curve, and let's have a look at the yield curve here, you can see what happened last week. This is where we settled. This is where we were 1 week ago. Look at the ultras, look at the bonds. They're just not moving at all. They're moving, what, 2 basis points? I mean, literally 2 basis points. And all the movement is in the 2s, the 3s, the 5s, and up to the 10s, which are moving much further. And let's do some maths. And I've done it for you. And you can do it yourself. All you have to do is go to something like the 5-year and have a look at what the DV01 for the futures is. So that's like, what, 1.3, 1.4 ticks for a DV01, and have a look at T-bonds. And so divide 145 by 31.25. And that's what, just over 4.5 ticks for a 1 basis point move. And then you look at the pricing of the options. So the straddle, which expires on next Friday in the T-bonds, gives you a straddle value of approximately 27 basis points, the at-the-money straddle. So the market is estimating that the maximum movement of the T-bonds is going to be 27 basis points between now and the close of next Friday. And if you look at the 5s, and let's face it, those are the only 2 option markets that actually trade, you are looking for 36 basis points. So 36 basis points in the 5s, 27 basis points in T-bonds. That is what the market is estimating the volatility to be in either. So to me, if he's somehow perceived to be hawkish, all he's going to achieve is to make the curve more negative. If he's very, I don't know, I have no idea how you can have a hike and then say that, well, it's not really a hike. But if he's perceived to be dovish, you will get a further normalization of this yield curve, and you will get the whole yield curve moving down. But I don't see how that can happen, because the twos really are going to be stuck, because I can't see the twos coming off too much. So what I'm telling you is that the most likely outcome through maths and through option pricing is that the fives move most and T-bonds move least. And that is what the market is telling you. And I think that that is what is priced in and is very sensible. And I actually think that the volatility of the T-bond is not going to be 27 basis points, not close to close, not close of week to close of week. And I also don't think that the move in the 5-year is going to be 36 basis points as the options have it priced. I think they're both going to be way lower than that. What of Germany? Well, again, highly technical market. Where do we close week on week? I mean, half a tick. So this is the Schatz. Thursday will be interesting to see what the Schatz reaction is. I doubt very much that we are very far away from this 268 because I think that even if they're hawkish, the market is more or less pricing it in. Let's change this to a monthly and see where we are. We could easily be in this kind of, area, that month on month, we just keep on going up and up and down and up and down. I mean, it could easily be that we are in the same situation as we were in 2003. Easily. Okay, so back to the dailies. I just don't see that there's very much to do unless we start breaking up and closing. But that will depend on what Madame Lagarde says and how hawkishly the market takes it. I am not convinced that this is going to start breaking out. I think it's much more likely to remain range bound and start taking people out on the downside. If we look at the tens, I'm much more inclined to believe that we stay in the range that we've been since September, rather than expanding the range. It just doesn't make much sense to me. If we look at, because the easiest way to do is look at the 2s, 10s. And I think that the trend of the 2s, 10s continues to be upwards until at least here another 20, 30 basis points, which tells me that the Bund is the one least likely to start breaking out to the upside in yield. If I can't see the the Schatz going berserk on the upside, I really can't see the Bund doing that either. And really, it's the differential that is telling me not to expect anything in anything. This is the differential between twos, Schatz and twos. Can it go another 10 basis points? Yes, but I think it's going to be very, very hard to break this level unless there is a very, very good reason to do so. And I don't think at the moment there is. 5s, 5s, big support area, and 10s, 10s, very close to big support area. what's that, 3 basis points? So I really don't see that we're going to get much movement in the spread between the Germans and the US. And if I can't see big movement in the US, that has to tell me that I'm not going to see big movements in Germany. 30s as well is beginning to get interesting. We're getting to a big area of support. We're very close to it, another 13 basis points. Where probably the risk reward is for a move back up towards 160, this kind of level, 150. So that's a 20 basis point in favor of Germany, if we get down there. So all in all, you can see highly technical market, very much reduced ranges. I think even what volatility is pricing is going to be wrong, i.e. too high. As I told you, the straddles are pricing in, 36 basis points in the fives and 27 basis points in the T-bond. I think the volatility everywhere is going to be lower than even the market is pricing. And it's not pricing a hell of a lot. So what to say about that kind of a market? Well, we just trade it just like we did last week. It's a trading market. I don't think that anything the Fed or Lagarde say, as opposed to what they do, is going to be very significant for very long, unless it's a real shocker. I mean, can they really shock the market if they want to? Yes, they can. But I just can't see any reason why they would want to. Certainly the ECB should be slightly more bearish than the Fed, but it's very much a question of tiny degree, as opposed to, completely different narrative. So I think it's steady as she goes. If we go back to the US, I prefer to, if something, unless something very, very significant is said and somehow the market rallies, I would love to buy the twos again at 4% or something like that, because I think the market, and this is worth saying, unless the market immediately sees an opportunity to make money by being long of bonds, it's not going to stick around long of bonds. Why? Because it has negative carry in these tenures. If you're funding something at 4.5%, and it's yielding you 360, like the 5 years are, every day you're losing money. So unless you see an immediate opportunity to make money and get out, why on earth would you stick around and take 90 basis points negative carry per day? It really is not something that big dealers do or love to do. So the only time you're going to get them involved is when they see an immediate opportunity. And then they're going to get out. They're going to make their 5 basis points, 10 basis points, whatever they want to make, and they're going to be out. Which gives you this kind of behavior, up, down, sideways. I don't think that that is going to change for quite some time. I don't know what to say about the dollar. I mean, how can I change my mind on something that closed completely and utterly unchanged on the week? I'm not going to do that. I think it's, getting towards support, and I think being exceedingly short down here is silly, especially since I don't see any change in the, as I showed you, in the relationship between the German and the US curve, or not much, in a range. That should tell me that the US dollar is in a range as well, right? can't really see any big movement. This, on a daily basis, this is 101.92, seems to be a complete magnet for the time being. Longer term, it's probably bearish, but what can you say? Certainly not for the time being. If we have a look at cash euro USD, we nearly got to this 109.92 to 110.64 area. That area to me is a get out or get short area. You know, on the weeklies, we're going to be very close to the 200 period moving average, which, you know, should give it a good kick down. So, you know, steady as she goes. Don't get caught long up here. That's all I can say. And as boring as the dollar was, so was gold. Unfortunately, I never got the opportunity to sell at 1959, simply because this is actually a change of contract, and it's the next contract up that traded up there, and never the front, the previous front, which was February, if I'm not mistaken. So this did not happen, unfortunately, this move up to 1958, which I would have loved to have sold, i.e. spot was never there. So I'm, you know, in my own portfolio, long only kind of thing, I am lightening up on gold, simply because I think it's done everything it should have done, and probably a little bit more. And I'm looking to pick it up back down toward between 1830 and 1881. If I can't see the bonds doing much, and if I can't see the dollar doing much, I really don't see the point of holding gold as a hedge for anything. I'd much rather hold something which is yielding rather than something which is not at the moment, and therefore I'm letting go. In terms of DBC, I mean, if we have a look at what's happened, the movements actually are so small. It's still, you know, in a bit of a bull phase, but I wouldn't put a lot of money on it. And certainly the spread of DBC gold is beginning to turn. Okay, it is beginning to turn, and while that is happening, it means that any reaction lower is going to get bought, or is going to be a buying opportunity. So, and that's worth actually looking at and enlarging. I mean, you can see how for the first time in a long time, we're actually beginning to turn these moving averages to the upside, especially this longer term one, which means that these any dip down towards 680 or 675 is going to get bought. That to me indicates that commodities are not going to go on a tear, especially oil. And if oil is not going to go on a tear upwards, that tells me that bonds are really not going to get smashed. Right? I mean, what possible reason can there be? And that to me says that we have relative stability over the course of a protracted period of time. So I'm not a buyer of DBC, and I'm certainly not a buyer of oil, because if you look at it, all we're doing is we're holding very long-term support and trading sideways. And on a daily basis, you know, we've turned the 200-day moving average, so any little spike up is going to get sold. So I really don't see all this narrative that we're in some kind of a bull market for commodities, I don't see it. I think it's rubbish, and therefore, if we're not in a big bull market phase for commodities, why should we be in a big bear phase for bonds, right? I mean, look at it. This is where we opened 2022, and this is where we are now in oil. I mean, what are we? A couple of percentage points away from where we were. And all this, you know, oh my God, war, oh my God, this, oh my God, that, at net result, nothing. So all the people who are telling you that oil is on a tear, commodities are on a tear, just show them this chart and say, really? Why isn't it in the price? And to me, this says more stability in the bonds. And the more stability in the bonds, the more stability in equities, and the more stability in equities, the lower the volatility, and the lower the volatility, more people have to chase. End of story. Okay, so all we need to do really to understand what equities are doing is tie them into bonds and the other risk indicators, which basically should show you where we are. This is ITOT over the government bonds, so the totality of the stock market against the totality of the bond market. Are we breaking down? I mean, are we in risk off? Are we going anywhere? I mean, this is 2022, okay, and this is where we are now. I.e., we are completely unchanged in that relationship. We've been up and down, and we are nowhere. But we are not in a bear phase, okay? If we thought that equities were going to somehow underperform TLT, we can have a look here. SPY TLT is basically exactly the same as where it was at the beginning of the year. So TLT is up, let's call it 7%, and equities are up 6%. So the relationship between bonds and equities is absolutely holding steady. What bonds do, equities will do. And you know, there might be a bit of a lag of a few days, etc., etc. And that gives you your expectations. If my expectations for the bonds are correct, then my expectations for equities are going to be correct with a day or two lag, either, you know, sooner or later. So that is all there is to be said. If we are definitely not in a risk-off phase. I know that a lot of people are going to say, don't look at SPY over XLY because XLY is basically Amazon and Tesla. Okay, it's Amazon and Tesla to 50%, but the direction is important. Maybe they're going to say the speed and depth of the move is distorted by those two, but not the overall direction of the move. So this is SPY over XLY. You can see when it's in risk off, it goes up. When it's in risk on, it goes down. And even if that is exaggerated, RCD over RHS definitely isn't, because that's equal weight. And as you can see, from the beginning of the year, we've done nothing but go up. Can you come back and retest these levels? Absolutely. My argument is not that equities are never going to have any kind of a pullback. Of course they will. But what I'm saying to you is that pullback, from what we can see at the moment, from all the data and pricing that we have at the moment, is going to be a 2%, 3% pullback. It's not going to be a 10%er. That is very, very important, because every time the market backs off 100 points in SPX, you shut your eyes and you buy it again against the support level. That is what these spreads are telling you. These spreads are not meant to tell you it's never going to come back, get on board now and stuff like that. They're meant to give you the overall long-term risk phase of the market. And that is, at the moment, still positive. And that is precisely what RPAR is telling you, risk parity. This is not a perfect ETF by any stretch of the imagination, but it's good enough to give you an overall picture of what it's looking like in risk parity land. We are approaching very good resistance, which is still, quite a way away in percentage points, and these gaps. So what the market is telling me is that we are still in a negative longer term phase, but that we are probing ways to turn the tide longer term. Whether it's going to work or not, I have absolutely no idea, and there is absolutely no need to make up your mind now. But it's telling me that we are getting to overbought levels, and that once we've seen those levels, the likely next move is going to be a nasty move down. And let's have a look why we could get a nasty move down, not anytime soon, i.e. not in the next couple of weeks, but longer term, why these levels are beginning to become rich. They're not rich at the moment, okay? There's no rush to go and buy puts or anything like that. It's still a trading market with an upward bias. But let's have a look longer term why we are probably somewhere near, within a few percentage points of levels where it makes no sense to hold equities anymore. And here we are. This is the reason. So let's put it all together. Bonds not going anywhere. Therefore, the times 18 Blue Angel with this level of yield really is the markets that are going to start breaking 18 times. I think it's unlikely. He can break it by a little, but I don't think he's going to break it by a lot. Which basically means that while this is, it's all, it's telling you that it's all up to earnings. Is it consistent with logic to expect earnings to continue being in the range that the analysts are predicting when every single company, or most of them, are giving warnings about the first half of 2023, or at least are saying that there's very little visibility that they have for the later part of 2023. I think the big shock could be that basically the market just goes sideways for a long time around this times 18, because let's face it, we're not going to know what earnings are going to be for let me rephrase that. We are going to know very quickly, i.e. This week, what the big earnings for the big tech companies, for the big capitalization companies in the index are, but those are earnings for Q4, and I never expected earnings for Q4 to be bad. It's the question on the market's mind is, do we go into a recession which lowers the E component anytime in Q1 or Q2? And if they keep on warning and saying we have very little visibility, why should the market move a hell of a long way away from times 18? Not unless bonds make a big move, right? And I can't see that, and therefore I can't see the equity market doing a big move to the upside. What that tells me is that as long as these Blue Angels have a bit of a downward slope, the ability of the market to go too far away from times 18 is very limited. And therefore that the shocks that the market is going to have, whatever it happens to be, a piece of news comes out, something happens, the volatility is all going to go from those levels, the volatility is all going to be to the downside towards times 16. And plus, we all know that the expectations for something like $225 worth of earnings are pretty much unrealistic or optimistic. So I really don't see the market going too far on the upside from these levels, um, just above times 18. So we could have another 3-4% in the market easy, but that is about it. And I wouldn't play this last 3%. I just don't see the point. Therefore, I am slowly turning into a seller of equities. So where do I think we will be Fed time? Well, probably, not very far away from 40.45, 40.50 on Wednesday. I really can't see the market going into Fed right up against the upper Bollinger Band of the 195s. And if we change that for a daily, I mean, going in it right at the upper Bollinger Band of the dailies is, well, silly. So we let these move up by 2 or 3 days, and we consolidate and we move sideways for 2.5 days. And then we are ready to explode up towards 4,200. That's why, I think that we are going to do nothing for 2 days, go sideways to down, catch up with all these moving averages, and then we are ready to make the move. Could it be up? Sure. Could it be down? Also possible. But I think somewhere around here would be a nice place to go into the Fed. What's that? Just above 40.50 on the ES. So why do anything for the first couple of days? We have optionality with our 1x2. I really don't think that we're going to test the downside very much. And therefore, life is good. We don't have any reason to do very much. But what you can see is that, and actually this is easier seen on my very clean chart, and I'll enlarge that. Every time it's got to these levels, and this is 41.26, it's had a lot of trouble, whether it's 41.26 or just above. I could put another line here, and I think actually that's a good idea, and I'll do it now. $41.26 to 41.66. Very, very difficult, because that is just above the 18s, isn't it, that I just showed you? That's the kind of stuff that basically the market breaks these highs, everyone gets bullish, it gets up to this 41.66, and then it's ready to turn over and basically trade a range. I'm not bearish. I just think that the Blue Angels are going to be very difficult to find a rationale to start breaking them hard. Blue Angels don't turn on a dime. Earnings expectations don't turn on a dime. Especially unlikely in this environment, because if the economy starts going great guns again, the Fed is going to want to tighten again, and maybe accelerate the tightening. And that is one thing that I need to tell you. The only thing that would make me bearish on Wednesday, that Jeremy Powell could say, that would make me bearish, is that he says that we are ready to re-accelerate hikes should the data warrant it. Because that's a hint. Why does he need to say that? He doesn't need to say that. That to me would be a sign that he is actually thinking, or that he's afraid that things are not going as well as he would want them. The data, I think, is going as well as he would want it, but that would give me a hint of his state of mind. So I really can't see a reason why the market should break this 41.66 area, or if it does, it's going to come right back to it at some stage. To me, that is really all you're likely to get out of equities for quite some time, and then you go back down and fill some gaps, right? We still have gaps all the way down to the 3,800-ish. So I think it's a big range, and I think it's a big range out of a reason. Now, the thing that actually is going to keep us in a range is this, which I think NQ is now actually outperforming and leading. And I think NQ certainly has room to get up to these kinds of 12,700 and possibly fill this gap all the way to 12,700. And if it does that, it's going to keep SPX from going down. This tells me that NQ is basically supporting the other components. And let's face it, the Dow has done absolutely nothing all year. Okay, let's get a daily chart. What has the Dow done since 2023? Nothing. It's up, what, 0.5%, 1%? So the Dow had its moved, it led, and it's now doing nothing. And it's now NQ which is catching up with it, because it's saying, well, things aren't as bad as we thought. A lot of the stuff that's in NQ, which was wildly oversold, is getting covered back. But the real leaders of the economy, the really big companies in the Dow, are not doing anything, right? They led, and now they're doing nothing. And while they do nothing, as soon as NQ fills those gaps, and let's go back to NQ, and fills those gaps up to here, then NQ will be ready to come down too. Okay, so it's a range. Under the hood, certain things are happening. We are still bullish, but we really don't see at the moment any reason to sell, but also we are just looking to buy 2-3% moves, and also to sell 2-3% moves to the upside with those levels that I've just shown you. And that is precisely what volatility is saying. Don't expect too much. We've finally filled this little gap that we had. So just showing you, last year we had volatility doing not very much and the market going down. And this year we're having volatility very stable and the market going up. It's just mean reverting this whole relationship between volatility and the markets. And you can see that in the foreign markets as well. DAX has been doing nothing for days while the S&P has been going higher. The DAX led and the S&P is catching up. We have very, very good resistance in the stocks, and it's unrealistic to expect this to start busting upper levels at the moment. It's just not going to happen. The Nikkei 2, we had the reaction. This is the reaction to what the BOJ did, i.e. nothing. And now people who sold it down here are basically chasing it, and they'll chase it all the way up to 28,180, and then they'll sell it again. And that gives you, the flavor for what this is. This is one huge range in which people get too bearish at the lows and get too bullish at the highs. Whether you're looking at DAX or stocks or Nikkei, it's the whole the same story. Volatility stays low, the markets get overexcited on the downside, and the market gets overexcited on the upside. And I just keep on looking at the Blue Angels, and that tells me everything. When they're over times 18, you shut your eyes and you get out of your longs and you wait. Because even if the market eventually is going higher, it's going to take a hell of a long time to decide that it needs to go higher, and it will trade those levels again and again and again. As you might imagine, I haven't really changed very much in these levels. I would love to see the S&P up here. I think that is a great way to, a great place to initiate a short. And I think there are certain odds that say that we might get up there because these levels should trade. And I think NDX is now definitely leading. But let's see what the Fed says. I think we're not going to go into the Fed a million miles away from the 4,000 level. So just we're going to play it. Sorry, not the 4,000 level, the 4050 to 4100 level in ES. Yeah, I really don't know what to tell you. I've given you an overall picture of how all the asset classes fit together, and I think it's important to keep in mind that we are still in a risk-on phase, but that we're basically running out of oxygen at these levels for the reasons that I've given you, and therefore that does not mean we're going to have it doesn't mean that we're not going to have violent moves, but it should mean that all of these moves are retraced. So that is the kind of market we're in. There's no point in forcing anything, and I will naturally be with you on Wednesday throughout and Thursday for the ECB, and hopefully we're going to have some good trading opportunities. But remember that that's all they are. They're trading opportunities. I don't think that unless we see something that no one expects at the moment from the Fed or the ECB, and you can't exclude it, I really don't think these are going to be positioning opportunities. Rather, they're going to be just trading opportunities. Thank you very much indeed. Have a wonderful weekend, and tweet you tomorrow.